Hello there, it's Miles Pitcher from Superior Lending. I hope your day is going great. So my tip for you today is dealing with our clients during a rising interest rate environment. First, here's my business card if you guys need it. Scan the QR code. It will take you to it. Still loving this technology. It's great that this is fully customizable. I send it to my clients and they have a spot where they can contact me, text me, email me, get to my website, apply, and upload all their documents through a secure portal. So very cool. Okay, so here's the big news going on right now is rates have taken a really rough week. The trend here is the chart's moving down, which means rates have been on the rise. So kind of rough. I'll remind you again that in the big picture, this is not a big move and it hasn't hurt rates that much, but the trend has been that rates are getting worse on us. I wanted to throw in this chart for you guys to see historically where we've been, and then also what is projected by Freddie Mac and a lot of the others and experts in the industry on where we are going on rates. So yeah, rates we kind of know are going to move up at some point. There's a lot of variables that go into it, but I wanted to talk to you guys today more about that. But first, I want to remind you of a couple of updates. Second home and investment properties, the penalties on those are gone. They've been removed for a few weeks now. So that should help your buyers or anybody refinancing second homes and investment properties. And then another reminder that the update to Fannie Mae guidelines on including as a positive compensating factor the rental history for a first-time home buyer and also the averaging of their median credit scores is live now. It's in place. It's happening. It's working. You can go look at some of my prior videos to get the details on those, but those are in place and those are great talking points for you and your clients. Okay, so let's hop back to our rising rate situation. A little bit of what we're seeing going on. Please be positive, right? Remember to have them look at the big picture. We find so many times that clients get stuck on that their sister-in-law got a 2.5 rate and that they can't stomach the fact that they're getting a 2.99 or a 2.875. We don't talk rate very much with our clients. We focus on what their monthly payment is and if they are comfortable with that monthly payment. And we work within those numbers. So please remember that. Please be positive. You can make a huge difference in letting your clients know, wow, rates are still phenomenal. So with rising rates, buyers' purchasing power diminishes. They can't buy as much home. So how do we deal with that? Here's some ideas. Number one, we need to make sure that we always look and see if discount points make sense for the client. And we do that by looking at the break even. So we look and see, how much would it cost to buy the client down an eighth or a quarter in interest rate? Okay, if that costs $1,000 and we save them, I'm just picking numbers out of there here, but $35 a month. So if it's $1,000, $35 a month, that's going to take them 28 months to recoup the cost of buying down the rate. Sometimes that makes sense. Sometimes it doesn't. But we should always be looking at it. By them getting a lower interest rate or buying down the rate, they'll be able to qualify for more home. A big one is private mortgage insurance. And I've talked with you guys about this before, but there are multiple companies that provide mortgage insurance on conventional loans. FHA, USDA, they are provided by the agencies themselves. Their PMI rates do not change. But on a conventional loan, PMI varies by credit score and how much down payment you put down, and the company that you're using. Other factors also include, are there multiple borrowers that have incomes, credit scores of both borrowers? So there are other factors. We see a massive swing in between some of the companies we use. So you need to be able to look around and look at those options. Other options are being able to buy out the mortgage insurance. That's a huge deal. I had a client I helped a couple of weeks ago who has had a little bit of PMI on their loan. She was able to pay an $800 fee. It was a cost to reduce her PMI. And it dropped her PMI from $60 a month all the way down to about $20 a month. We call that a split mortgage insurance, where you pay a little bit of upfront and then your PMI is smaller. Again, it's another way, another option on how to retain that purchasing power for your clients. Homes with accessory dwelling units or mother-in-law apartments, these are great. Just know that there's only one loan product that allows for you to count the rents off the other unit. It's a Fannie Mae product. They have to be first-time home buyers, and there are restrictions on how much money they make, but it's a great option for some of your first-time home buyers that are struggling to be able to afford their first home. Credit repair is a big deal. So as I mentioned, with PMI, credit affects the private mortgage insurance, but it also affects the interest rates. So if somebody can come in and we can help find ways to boost their scores from 690 up to 720, they're going to get better rates, lower PMI, qualify for more home. Another issue with rising interest rates is our borrowers who are going under contract on new construction homes, 6, 9, 12 months down the road. They are at massive risk of interest rates rising up on them during that period. Most preferred lenders will only give the client a 30-day lock on their interest rates, which means the home has to pretty much be done. We have a couple of clients, even right now, that we locked in a month ago with a 90-day lock. And at that time, the interest rate was a little bit higher on that 90-day lock. But we put it in, we locked it in, just kind of as an insurance policy. And now with rates getting worse, boy, we are so happy we did that. Their homes will be done in the next 60 days or so. And we are looking great that we did that. So make sure that new construction clients talk with a lender that has the ability to do extended lock periods. That's a big deal. Now, another question you should be talking to the clients about is, how long are you going to live in this home? And if they know that they're here for 5 years and then will transfer back to California or wherever they came from, there's no need to do a 30-year mortgage. Get into a 10-year ARM where it's fixed for 10 years and then it goes adjustable after that. They'll be gone before the loan even goes adjustable. This 10-year ARM is a phenomenal product. We did one a couple of months ago for a client. Rates are in the low 2s on this. It's a great, great product. Let me know questions you have. I'll keep sharing ideas on how to deal with the rising interest rates, but we want to make sure that clients are given options, especially in a rising rate environment. And then we also want to make sure our clients understand every fee. Have a great week. This is Miles Pitcher with Superior Lending.